Hello everyone and welcome to Financial Accounting 1A. In today's video we're going to start with accounting for retail businesses. So as I said before, the first 4 chapters were really critical because these set the foundation for financial accounting. Starting from chapter 5 we're going to see new material, and our focus here is to cover how accounting is done for retail businesses. So in retail businesses, one of the key things is inventory. So these kind of businesses, they buy inventory or merchandise from suppliers, usually in bulk orders, and then they sell it to individuals in individual transactions. So the unique thing here is that we're going to see the purchase and sale of inventory. In the previous 4 chapters, we were talking about service businesses, where the business was we had Net Solutions. Net Solutions was only providing consultation services, so it was basically service. But starting from today, we're going to see a new kind of business, which is the retail businesses that involves inventory. So to get an idea more about retail businesses, or the nature of retail businesses, as it says here, retail businesses sell merchandise that they have purchased from other companies to consumers. So companies selling the merchandise to the retailer are called suppliers or vendors. So we can sometimes use the term suppliers, sometimes vendors, but they're the same. They are the ones who supply the merchandise to the retail business. The transaction between the supplier and retailer are called business to business, because here, when I'm buying from a supplier or vendor, I'm not really buying it with the purpose of using it. I'm buying it with the purpose of reselling it. So we call this kind of transaction business to business transaction, or B2B. Transactions between retailers and consumers are called business to consumer transaction. This is when as a retailer, I'm selling to the final consumer. In this case, we call it B2C. So the operating cycle for a retail business starts with cash. So we have the cash, we purchase merchandise from a supplier. The merchandise arrives to our warehouse, we sell it, and then usually we have either cash sales or account sales. So if we have a sales on account, we have a promise from our customer to get the cash in the future, and this is what we call it accounts receivable. Then we take this accounts receivable once it's paid or collected from the customer. Then we go through the collection and we get the cash again, and the cycle keeps going. So let's see the difference in the financial statements between service and retail businesses. I think it's nice to see them side by side. So these differences are illustrated in the following income statements. So here, the traditional service business income statement that we've seen before, where we have fees earned, we subtract from it all the operating expenses to get the operating income. In the retail business, it's a little bit different. We have an account called sales. Sometimes we can call it sales revenue to stress on the fact that this is a revenue. So it's sales, and then we subtract from it the cost of goods sold, which is the cost we paid in order to acquire the product sold. So we get the cost of goods sold, subtract it from the sales, and we get the gross profit. And then we subtract operating expenses, which is very similar to the service businesses, to get the operating income. One thing that we have to keep in mind, usually the selling price is higher than the cost of any item we sell. So we expect that sales would be higher than the cost of goods sold. So I buy a product for $8 and I can sell it for $10. That's the only way I can have gross profit. And I need to make sure that I have good enough gross profit to cover my operating expenses, so I end up having a positive operating income. So that's typically what businesses try to do, or retail businesses try to do. They need to have higher amount of sales. That's why they mark up their products compared to their cost, so they can have a positive gross profit, and then this gross profit should also be big enough to cover the operating expenses, so they can have a positive operating income. So the revenue activities of a service business involve providing service to customers. When merchandise is sold, the revenue is reported as sales, and its cost is recognized as an expense. This expense is called the cost of goods sold. So remember, the cost of goods sold is an account that we'll see always on every single income statement. for retail businesses, and this is some form of an expense. It doesn't have the word expense, but it's an expense account. Sometimes we give it the name cost of merchandise sold. So cost of goods sold, cost of sales, cost of merchandise sold, all of these are different names for the same thing, which is cost of goods sold. So the cost of goods sold is subtracted from sales to arrive at the gross profit. This amount is called gross profit because it's the profit before deducting any operating expenses. The operating expenses are later subtracted from gross profit to arrive at operating income. Merchandise on hand, which are the items not sold or inventory that's still left on hand. At the end of an accounting period, we call it inventory. To be more specific, we like to call it also end inventory, but the account itself is inventory. Sometimes we call it merchandise inventory. So again, the term we use in accounting for merchandise that we buy and sell is inventory. So inventory is reported as a current asset on the balance sheet. It's one of those balance sheet items. It falls under assets, and to be more specific, it's a current asset. Why it's current asset? Because no business has any kind of intention to keep the inventory for a period longer than a year. So it's considered to be one of those short-term assets that we buy with the intention of reselling it in the near future. So merchandise transactions are recorded in accounts using the rules of debit and credit. So we're going to see how the journal entries work, but again, when we have a purchase transaction, sales transaction of inventory, we have to follow the rules of debit and credit. Since merchandise transactions differ from those of service businesses, a new chart of accounts is used, and we'll see that in the next slide. The accounts related to merchandising transactions are highlighted in blue, so we can see what are the new accounts that are added to the chart of accounts. So here we still have Net Solutions, but now let's assume that they are a retail business. So you see the traditional accounts that we talked about before, like cash, accounts receivable, office supplies, prepaid insurance, land, and so on. But now we have a new account, which is inventory, and another non-traditional account, something called estimated returns inventory, because sometimes we return some of the inventory we purchased, so we have an estimate for that. Then we have the liabilities. You see here like customer refundable payable and estimated coupons payable. These are new accounts that we're going to get exposed to. But other than that, every single account that we've seen before for assets, liabilities, and equity are the same. If we look at the revenues, now instead of fees earned, we have the account called sales. And that's another account related to revenues. In some textbooks, they also call it, and some companies, they call it sales revenue, again, just to stress on the fact that this is a revenue account. And then part of the expenses, we have the cost of goods sold, we have delivery expenses, because now we have inventory that has to be delivered, and sometimes we pay expenses for that. So these are the kind of additional accounts that we see on the revenue and expense side. But other than that, I think all other revenues, expenses, assets, liabilities, and equity accounts are the same. So now let's talk briefly about something called the subsidiary ledger. And the subsidiary ledger, from its name, it just falls under the general ledger. We have the general ledger where all the main transactions are recorded, but we also have subsidiary ledger to clarify a little more details for accounts, for example, like accounts receivable, accounts payable. We really don't want to overwhelm the general ledger with single transactions related to specific customers or specific suppliers. So we sum them, or we sum them in the subsidiary ledger, and then their total is taken in directly to the general ledger. So as it says here, a large number of individual accounts with a common characteristics can be grouped together in a separate ledger, which we call it the subsidiary ledger. The primary ledger, which contains all of the balance sheet and income statement accounts, is then called the general ledger. And this is the general ledger that we've been using before in chapter 1, 2, 3, and 4. But once we have the retail businesses, we're dealing with the number of customers, number of suppliers, also number of inventory accounts. So that's why we have to use subsidiary ledger that can be summarized later on in the general ledger. Each subsidiary ledger is represented in the general ledger by a summarizing account called a controlling account. And this is basically the idea that I really want you to be aware of. So common subsidiary ledgers are ones like I just told you, like accounts receivable, accounts payable, inventory subsidiary ledger, and they have like specific customer accounts, specific vendor accounts, specific inventory items, and then we summarize all these in the general ledger using the control accounts at the very end. So the accounts receivable subsidiary ledger or customer ledger lists the individual customer accounts in alphabetic order. So we have all our customers and we just go by alphabetic order. The controlling account in the general ledger is what we call the accounts receivable. For the accounts payable subsidiary ledger, or sometimes they call it creditors ledger, because these are people we borrow from, we have to pay them in the near future, these are our suppliers or vendors. They list the individual creditor accounts in alphabetic order. The controlling account in the general ledger is accounts payable. The same thing works with the inventory subsidiary ledger. So sometimes we simply call it the inventory ledger. It lists individual inventory item by item using their barcode number or item number. The controlling account in the general ledger is simply inventory, and inventory subsidiary ledger is used in a perpetual inventory system. We'll talk about these two systems briefly. We have something called perpetual inventory system and something called periodic inventory system. Nowadays, most businesses, with the help of technology and computers, it makes it much easier to use the perpetual inventory system compared to periodic system. Periodic system was a system where we used to calculate cost of goods sold only once a year or once every 6 months. But using the perpetual system, as the name implies, perpetual, which is continuous, you can calculate the cost of goods sold after every single sales transaction. So most retail companies also use computerized accounting systems that record similar transactions in separate journals, which generate purchases, sales, inventory reports. These separate journals are called special journals. So let me stop here. In the next video, we're going to go over the purchase transactions and we'll see how these are recorded.